Peter Boockvar, Chief Investment Officer at One Point BFG Wealth Partners. Let's go back now to the markets, Peter. You got a 10-year at 4.42%. To Guy's point, to Tim's point, we're looking at Japan and their move, because our bond market is not the only one that is moving around the world. I want to highlight that. In fact, in some cases, other bond markets are moving a lot more aggressively. How much is that impacting the trade for stocks right now?
I think it's definitely part of the equation. And also you have jumping yields in Europe. You have the UK 10-year gilt yield, which closed above 5%. So it is a developed market global bond sell-off. And it's not just worries about inflation. Even before this, there were growing concerns about debts and deficits. And what we're seeing now is only going to enhance that, whether it's government spending on consumer subsidies to try to temper the impact of the energy crisis that's going on, whether it's going to be a huge ramp up of defense spending. There is, again, a major rethink, an investor desire to take duration risk. And the ripple effects are wide. We know we have a very over-levered global economy, particularly on the sovereign level, but also at that corporate level. Going into the war, we were worried about private credit. Well, all these portfolio companies that were hoping for lower interest expense because of the cut in the Fed funds rate, well, that has disappeared. So funding costs going up affects everything.
So, Peter, when you look at it, I look at it through a different prism. Extend out for me, and I'm finding that I still keep circling back to lower rates. Now, the bond market's doing what the bond market does around the Fed, so it's not reliant on that. But when you fast forward, I do believe we're going to get back to a rate-cutting environment for a couple of reasons. A, if we slip into a recession, they're going to cut rates. B, if Powell moves from that seat, they're going to cut rates. And C, if they try to make the mistake, which I think is a mistake, of raising rates into a supply shock of oil, they're going to wind up pushing us into a recession, and that winds up into a rate-cutting cycle. Just comment on that for me.
Well, a couple of things. The Fed's cut 175 basis points, and the 10-year yield is higher than it was in the summer leading into those initial cuts in September 2024. So even if they cut, doesn't mean that the rest of the curve is going to accommodate that. If the 10-year yield doesn't think that the Fed should be cutting because of inflation and we said debts and deficits, well, the Fed may cut the short-term Fed funds rate to call it 3, but the 10-year yield may go to 5. Or are we better off? Well, depending on where in the yield curve you're borrowing, will determine that. So I don't just think that Fed rate cuts are going to solve the whole curve. And one key thing here, if the Fed, the pain point in the economy is inflation. Companies right now are limiting their hiring because they're trying to cut costs. They're trying to preserve profit margins. So if the Fed starts to cut in response to that weakening hiring, are companies all of a sudden going to hire again? No, they're focused on cutting costs right now. So if inflation is the main pain point, which I believe, that I think should be their main priority, even if the economy slows down, because I don't know what rate cuts are going to cure.
Well, also, I will remind our audience, helpfully, I'm sure that, Peter, that the Federal Reserve cut rates by 0.5%, kind of a shock 0.5% cut in September or whatever of 2024, when inflation was pretty much exactly the same as it is now, although we know inflation is going to go up because of the price of oil. I just want to throw that out there. What is the bond market seeing that the Federal Reserve is not communicating? Because the Federal Reserve hasn't said we're going to raise rates, right? There's still talk of potential rate cuts, and the bond market is pulling a honey badger in that it doesn't seem to care.
Because I think the bond market is complicating central bank decision making, because if I'm right, that debts and deficits do matter, well, then just analyzing the longer end of the yield curve is not just a growth and inflation thing. It is, do we want to lend money to these over-levered governments? Yeah, maybe they'll pay me back because they can print the money, but if they're going to do it in degraded currency, well, then why do I want to own long-term bonds? So I think that is a major thing here. And I say that because we're seeing the same bond market reaction in all the many over-levered countries, like Japan, like the UK, like France, and growingly like Germany, whose debt to GDP ratio has quickly jumped from about 60% to 80%.